But there's one problem, and that is that banks are allowing consumers to. Canadian real estate prices seem to be going up again and again and again, with new highs continuing to be the norm. And now not only are prices going up, but sales are starting to go up as well, with transactions increasing 11.3% over last month. However, new listings continue to remain at a 20-year low. More than half of GTA condo investors are now losing money, but a quarter of Canadians still want to buy a rental property in the next 5 years. And on top of all this, rents continue to soar as non-permanent residents and foreign students remain uncounted in the population growth, which means the supply of rental housing for renters is significantly underserved. And this is causing vacancy rates in some cities to drop below 2%, which of course is a recipe for higher rents, higher costs, and higher inflation. And in this video, I'm going to discuss exactly why housing prices aren't falling in Canada, even though it's happening in other major countries. And I'm going to discuss what you should be doing to plan for the future. But before we get into it, my name is Nolan Matthias, and if you want to thrive financially, this is the place for you. So do me a favor, hit the subscribe button and hit the like button so more people like you can see this video. And don't forget, you can still get a copy of my new book, Mortgage Secrets, for free. All you have to do is go to mortgagesecrets.ca and pay the shipping and handling. And if you're in the market for a mortgage in the next 5 years, that book could potentially save you tens of thousands of dollars. Okay, so let's discuss what's happening in the Canadian real estate market, because even though it seems like housing prices should be falling, they continue to rise. In fact, the benchmark price for houses in Canada jumped to $724,000 last month. That is 1.6% higher than the previous month. And while this is still down 12% from last year, the expected drop in real estate prices just hasn't happened. And this is largely due to the fact that it is one of the tightest real estate markets in history. Unlike the last several years, where there were a lot of people who wanted to sell properties and lots of people who wanted to buy properties, well, now the market has shifted to there being less buyers and less sellers. And even though the number of sales is down significantly, the balance between sellers and buyers still remains significantly in favor of sellers. And combined with the fact that the Bank of Canada has put a pause on rising interest rates, it seems people are becoming more and more comfortable with their variable rate mortgages. And also with fixed rate mortgage pricing coming down, people are just simply more comfortable jumping back into the market. However, this isn't the only thing that's causing real estate prices to stay high. In fact, new research from CIBC is suggesting that more than half of landlords are now losing money on a regular basis on their GTA properties. And in a normal market, it would be expected that these properties would eventually come up for sale. However, it seems that real estate investors are holding on tight, hoping that the interest rate environment and the rent environment turns in their favor. And while the cost to buy a house is down significantly from last year, the cost to rent housing is up significantly, almost 20% in some markets and 9.6% nationally. And one real estate broker is predicting that by 2030, the average rent for a one-bedroom condo will be $3,000. And this certainly seems plausible in places like Toronto and Vancouver, where vacancies are at historical lows. In fact, as of right now, the average rent for a one-bedroom property in Vancouver is $2,700. Now, compare that to a place like Regina, which is about $1,000, and you can see there's quite the discrepancy across the country. And even at $2,700 rents, it's proving difficult for landlords to be able to carry the costs of their properties, which eventually should lead to many of these properties coming to market, which would potentially cause housing prices to come down slightly. However, at the same time, it would reduce the amount of rental stock that is available and subsequently cause rents to go up as well. But there's one problem, and that is that banks are allowing consumers to extend their amortizations up to 30, 40, and in many cases, significantly more years. And the problem with that is allowing landlords to hold onto their properties for significantly longer than they should, creating an imbalance in the real estate market that causes housing prices to remain high. Now, the question is, will that end? And if it does, what will happen? And it seems that the government and banks in general are very much inclined at the moment to want to see people be able to hold onto properties, not find themselves in foreclosure situations and having to liquidate those properties at fire sale prices. In fact, it seems as though banks just in general do not want to be taking over these properties, especially with the reduction in housing prices, because there's no guarantee that if they take them back that they'll be able to sell them and recuperate their costs. So it seems that in many cases, they'd much rather have the borrower continue to make the payments, or at least try to make the payments, and wait for the market to return to normalcy. And with housing prices continuing to go up, rents increasing, and interest rates remaining the same, that's leading the cost of housing to continue to increase, which is having an upward effect on inflation, which we all know is not a good situation. Now, it doesn't seem like there's a real estate market crash in sight. So the question is, what do you do as a potential homeowner in order to make sure that you're making the right decision for yourself? And the key thing here is to make sure that if you are looking to purchase a home, that you are doing it with the intention of purchasing for the long term. Real estate wealth, no matter what TikTok tells you,
how to make money investing in real estate. First, you buy this. Then you start renovating like this. Then you turn it into this.
Is built over the long term. And we know with certainty that if you own real estate 20, 30, 40 years down the road, you'll be significantly better off. And Stats Canada clearly has the data to prove this. And on top of that, do you really want to be the slave to landlords who won't be able to pay their bills, are going to be forced to either increase rents or sell the properties, potentially leaving you without a place to live? So there's a case to be made for controlling your own destiny and controlling your own future by purchasing a property if you know that you are going to be able to afford it and hold it for at least 7 to 10 years. And when you do decide to purchase that property, make sure that you get a mortgage that has flexibility built in case interest rates do go down. And I talk about that in my Mortgage Secrets book. Because the last thing you want is a big bank 5-year fixed with a massive penalty or a discount mortgage with the inability to refinance to a lower rate. And unfortunately, the ugly reality for many landlords is that they're probably going to have to hold on to properties for 5, 10, 15 years in order to recuperate the losses that have happened in the last year. And unless we see a significant uptick in unemployment, which may be possible, the chances of there being fire sales on real estate anytime in the near future are very, very low. So without trying to predict the future and whether or not housing prices are going to go up or whether they're going to come down or where interest rates are going to go, the only decision that you can make as an individual is whether or not it is the right time for you to buy and jump into the market based on the information that you have about your current financial situation. Because trying to time the market and buy at exactly the right time is a fool's errand. And there will be many, many people who choose not to buy, waiting for a market crash that never comes, ultimately either getting priced out of the real estate market completely or finding themselves in a scenario where their lifetime housing costs are significantly more. And if the former happens, which is you get priced out of the market completely, well, even though you may not realize it now, that will be financially devastating 20, 30, 40 years down the road when your net worth is significantly lower than it could have been if you had simply owned a home. Oh, and if you're currently renting and you expect that you're going to be able to jump into an average home of $735,000 right out of the gate, you're probably going to have to realign your expectations. Buy a smaller home, own it for a year or two, build some equity, and then purchase your next forever home. Oh, and if you want to know the 3 things that will help you break out of your financial rut and be able to afford the home that you've always dreamed of, make sure you check out this video right here.